50% of Indians' wealth is invested in real estate.
Really?
Absolutely. If I make some extra money, my most secure place is going to be real estate, then gold. Unfortunately, what had happened is that those residential apartments didn't really appreciate to the level that people wanted in values. So what we do,
Shiv Parekh
founder and CEO of hBits,
is transforming commercial real estate investing in India.
with an AUM of 500 crore.
during COVID, there was a little bit of a question mark that what's going to happen to the office sector? Are people going to come back to office? Are people not? And then here you are today in 2024 and we're beating 2019 numbers. And I think the largest reason is
So what's the future of fractional real estate investment in India? Shiv, so let's talk about the real estate sector as a whole because it's poised to hit $1 trillion by 2030. Tell us a little bit about what India real estate looks like.
So I think the last four odd years since post-COVID has been a very interesting time for real estate, and I think we can look at it in two sections, right? There's the residential real estate sector, then there's the commercial real estate sector. So if we talk about the residential real estate sector, prior to 2020, 10 years, it was effectively flat. And I think what happened during COVID is that and this is pan India across the top cities as well as second tier cities. I think individuals realize that there's no better time to buy right now because interest rates were at an all-time low. The psychology of individuals were the people who are always waiting for the market to correct. And at that point in time, people realize that there's no better time to buy because markets are not going to get worse than it is today, as well as interest rates being at an all-time low, along with the fact that people realize that they want their own apartments and they can't rent because of the challenges that they faced during COVID. So I think that post-COVID has caused a real uptick in the residential real estate sector, and you're seeing that in prices across all the cities. So that's just a quick bird's eye view of the residential real estate sector. Coming to the commercial real estate sector, and when I say commercial, I mean anything that's non-resi, whether it's office, retail, malls, schools, hospitals, but primarily the largest driver of that is the office real estate sector. So during COVID, obviously, there was a little bit of a question mark that what's going to happen to the office sector? Are people going to come back to office? Are people not? And then here you are today in 2024, and we're beating 2019 numbers by a mile.
After work from home has
After
become
work
more
from
popular.
home, yes. And I think the reason is there are multiple reasons. But I think the largest reason is one is the GCC boom, right? So if you look at it, 70 to 80% of Indian office occupiers, and I'm talking about grade A large commercial offices, are non-Indian companies. They're primarily American headquartered companies. And a lot of these companies are now outsourcing more and more value-add services to India. Earlier, India was the back office destination of the world. Now, more and more value-add services, front office, design, etc., are moving to India. Add to that, a lot of American companies saw that if our employees are working from home, why don't they just work from India? So yeah, just talking about the commercial real estate sector, I think there's, both the commercial and residential sector are doing extremely well across the country as of now.
So if you could share with us some numbers, say over the last 5 years, if one were to put their money in real estate as an asset versus in equities, would there be a huge differential?
And now I'll talk a little bit more about the commercial real estate space. I think in commercial real estate, what one can achieve obviously depends when you invest. And what we are doing is we allow people to invest post-construction of the asset and post the asset being rented out. So generally, investors get 8 to 9% in terms of the rental income, and along with appreciation, they can make a 15 to 17% IRR.
Okay.
So in equities, obviously, your potential return could be 20 plus % IRR, but it could also be zero. While here, your downside risk is limited. You're owning a hard asset; it's already constructed, OC is received, the tenants are already in place. So it's a very risk-free asset in that sense once you're owning that asset.
And what about rental yields? Because there's quite a disparity in the metros like a Mumbai and a Delhi. I think it's around 2 to 4% versus a tier 2 like Pune and Hyderabad where it's about 6 to 8%.
So that would be in the residential sector. I think
Yes.
your tier 1 or your top 3 cities would be about 1 to 3%. Maybe in your Punas and Hyderabad, you could get about 4 to 5%. But that's in the residential sector. If you look at the commercial sector, you are getting 8 to 9% rental yield across the board. So you're getting about 100, 200 basis points above your FD, for instance, or your risk-free interest rate. So that's kind of the delta you're getting in your rental yield in commercial assets.
Okay. Now let's talk about the alternative forms of investment, because that has emerged as a growing trend as well. For someone who has no clue about what this is, they only know traditional real estate investment, how would you introduce or explain this topic in a simplified manner?
Yeah, see, I think first, just at a high level view where we started from, if you look at where Indians invest their wealth and not counting someone's primary residence,
Okay.
50% of Indians' wealth is invested in real estate.
Really?
Absolutely. There's about there's probably single digits in equity and MFs, but 50% is in real estate. And I think the mindset always was that if I make some extra money, my most secure place is going to be real estate, then gold. So that's traditionally been the mindset, but that's been investing in, a second apartment close to you that you're comfortable with. That's primarily been the investment avenue. And unfortunately, what had happened is that those residential apartments didn't really appreciate to the level that people wanted in value. So while the investment has been there from a security perspective, the return hasn't been to the level that people would have hoped. So what we do, what this kind of alternative investment platforms are doing, is that they are offering these investments into higher yielding commercial assets.
Okay.
But commercial assets, minimum ticket size, even if I want to own a floor in a building. And let me give a little bit of a picture. These commercial offices, when we talk about, are your large glass facade buildings. So if someone's from Mumbai, it would be in BKC, Lower Parel, Andheri East. If someone's from Delhi, think about your buildings in Gurgaon. If someone's in Bangalore, your buildings in ORR. So these large glass facade buildings where your tenants could be a Deloitte or an Accenture. So this is where the return profile is significantly better and safer. The only difference is that your minimum ticket size to own that, even say one floor or one office, would be 50, 60, 100 crore. So that's out of the reach of most individuals, which is why residential investment has been, historically more prevalent. With a much smaller ticket size, one can own part of the property.
Okay.
So with 25 lakh, 30 lakh, 10 lakh, one can own part of the property and make the returns as if they were owning the full property.
So that is fractional real estate.
Absolutely. Yes.
Okay, so some people have described it as, imagine you go to a cafe and there's a pizza and you share slices with your friends. So imagine if that was, say, a commercial office.
Absolutely.
And you share the pie with X number of people.
Correct.
So is that how it would work? What would be the minimum investment amount that one has to put in? I know you said the ticket size is lower. How much?
So now with the new SEBI regulation, the minimum ticket size is 10 lakh.
Okay.
But exactly, your analogy is exactly it. You're sharing a slice of the pizza.
Okay. So if we were to delve into it deeper in terms of the kind of returns one could get, if we can compare it to how this is different from investing in traditional real estate in terms of the returns one expects versus fractional real estate or an alternative form of investment.
Yeah. So see, in traditional real estate, there were in fact two avenues that one could invest in traditional real estate. And I'm simplifying a little bit. But one is pre-construction, right? You had a lot of investors who would invest when a developer started constructing that property. And the second option is to invest in an apartment that's already constructed. Those have different risk and return profiles, and I'll talk a little bit about both. The pre-construction phase, obviously your return profile could be significantly higher, but your risk is very, very high. And there are umpteen number of people whose money has been stuck in unfinished projects. I mean, that's where RERA came from, right? Because people are investing in these developers with no regulation. And a bunch of projects in the early 2010s got stuck in this model. Yes, your returns could be high, but your risk was also high. And if your project gets stuck, then you're not getting your money back for decades on end. Then there's the other place where you could invest in residential, which is once the building is constructed, it's rented out. So in that case, obviously, there's no development risk, no approval risk, OCs received, you rent it out to another family. So sure, there it's relatively safe, but your rental yields, like I mentioned earlier, is about 2 to 3%. You have the headache of, managing that property, dealing with a family. You have 1 year contract. So if that family leaves, then you have to find someone else to a broker. So it's a little bit of a headache in that investment. It's not a simple click of a button. So those are how residential real estate investments happen. historically.
Yeah, of course. No, it's not as simple as a click of a button, but there are some inherent risks involved in fractional real
Absolutely.
estate investing, which I will get to. But let's just, if I could just probe a little bit more
Sure.
on that in terms of the IRR. With an IRR of about 13 to 18% for
Sure.
fractional ownership and a 7 to 8% dividend yield for REITs, how do they compare to a traditional real estate investment?
So like I said, in a traditional real estate, you get maybe 2 to 3%, and then your appreciation would be anywhere from 5 to 10%. So you would get about 7 to 10, 11% in traditional real estate. And in fractional, like you mentioned, 8 to 9% or 7 to 9%. And your IRR is about 15 odd percent is what you can make.
So, what is the opportunity? Now, someone's heard you out and they're saying,
Yeah.
okay, this sounds pretty lucrative. It's not as risky as I thought. I don't have that much capital. So, this sounds like something that's doable. How many fractional real estate platforms are there in India? How does one get started?
So how does one get started? There are, I think, about 3 sizable players in the market, 2 Bangalore-based, ourselves based in Mumbai. In terms of how does one get started, obviously, I'd recommend someone to look at only the credible fractional ownership players. And when I say credible, I mean have a decent-sized AUM. And also look at the background and expertise of the people who are managing the whole show, what expertise and knowledge they have in real estate, and how they're acquiring this commercial real estate, what process they have into acquiring the best property, how they ensure your commercial diligence, technical diligence, legal diligence is done, so that your investment is safe, firstly, and then after that can deliver the returns that I mentioned right now. That's just at a high level how I'd recommend someone to go about it. And then obviously there are multiple parameters one could look at before making their final investment decision.
Okay. So I guess even consulting, a certified, unbiased financial advisor
Would help.
would definitely
Absolutely.
help. Now, assuming that it's a private limited, how exactly is it structured for an individual to partake in this?
Yeah. So there's a structure that has been prevalent for the last 4 or 5 years. And now with the SEBI regulation that's come up on March 8th, there's a slightly new structure that people are moving towards. So to talk about what it has been, earlier every asset was placed in a separate private limited entity where investors got shares and CCDs, compulsory convertible debentures, as per the amount that they've invested. So say it's a 50 crore property and you have, say, everyone putting in 25 lakh, you had 200 investors who would become shareholders and debenture holders in that private limited company that would then own the property. On a monthly basis, rent would go into the private limited company from the tenant and then be distributed to all the investors. And then one investors can sell their share at any point in time they want to another investor through our platform or through their network if they found someone. Or in 4 to 6 years, we look to exit the full property and give the appreciated returns to investors. So that's been the traditional model so far. Now what SEBI's done, and to give a little bit background on SEBI. So SEBI obviously took note of this industry about a couple of years ago in 2022. So they called us and in fact, I think probably they spoke to a few of the other players. They understood what was going on and they asked us, would you like regulation? And we said, absolutely. So we put in what we think the regulation should look like. Last May, they came up with a consultation paper. I think about 70 odd, they got 70 odd comments from the public. In November, the SEBI board approved it. And this March 8th, the detailed notification of the regulation came out.
So what does the detailed notification say? Yeah.
So it's called SM REIT, small and medium REIT.
Okay.
So it's a subset of the larger REIT regulation with certain nuances. So now what the structure is going to look like is it's going to be a listed trust the same way a REIT is. So in a way, it's a combination of the REIT regulation and the mutual fund regulation. It's a REIT regulation in the sense that it's listed and investors will own units of that trust. It's a mutual fund regulation in the sense that there are various schemes of that trust and you can invest in a specific scheme and each scheme would represent a specific asset. So while in a REIT, traditional REIT, you're owning a basket of assets. Here you're picking and choosing which asset you want to invest in. So that's high level, the high level what the regulation is. To get a little bit more into detail, you're allowed to take assets that are between 50 and 500 crore. And the minimum ticket size is 10 lakh, like I mentioned, from an investment perspective. So those are kind of the major points of the regulation. I think probably before March end, we hope to list our first asset. And I think you'll see a few of the other players also listing their first asset on the SM REIT.
Shiv, you touched upon the concept of REIT, which of course is a little bit more advanced than a fractional ownership in terms of the concept that's been around longer. What exactly is a REIT, if you had to explain?
So the traditional REIT framework was, it started out actually again in the US and it came to India. I think the detailed regulation came out in 2014, and in 2019, the first REIT was listed in India.
Can you tell investors or viewers what it stands for?
REIT is REIT, Real Estate Investment Trust. So a REIT effectively allows you as an investor, again, to own a share in a property and make the returns associated by owning the whole property. The difference obviously is that a REIT, I'd say, is more similar to a mutual fund. So I'll say that there are 4 listed REITs, right? So there's the Embassy REIT, there's the K Raheja Mindspace REIT, there's a Brookfield REIT. So these are 3 office REITs. And the fourth one is the Nexus REIT, which is a mall or a retail REIT. So, for instance, if I take the Embassy REIT, they would be owning buildings in Bangalore, in Mumbai, across the country. There will be probably 100 different tenants or 200 different tenants in the portfolio paying rental. And then that would be distributed proportionately to all the investors of the REIT. So that's effectively what a REIT is. And in India, it's still a very nascent market. I mean, I don't know the numbers in the US, but you even have jail REITs, for instance, in the US. Yeah, jail's privatized, so you're investing in the jail property, for instance. But it's a basket of assets, so it's like a mutual fund, right? You're investing in multiple different stocks. While in SM REITs, you're investing in one stock or one asset that you've decided to invest in. The other difference, which is it's not really a regulatory difference, but it's the way the market has evolved, is that the 4 REITs today have, for the most part, only they are the developers and they've listed their own assets, which is not the case in SM REITs because it's third-party assets that we're taking. Or, for instance, even in the US, there are a lot of professional REIT managers. So they would create a REIT, buy other assets that they've not developed, and then list that. But I think that will happen slowly as the market evolves in India.
What are the benefits of investing in a REIT?
So I think effectively, right, REIT, SM REIT, ultimately you're owning an underlying constructed assets that's already rented out. So what I discussed earlier, it's relatively the same. You're making this 8 to 9% rental yield. Your tenants are, like I mentioned, large MNCs. And you're getting your regular 5 to 7% appreciation. So effectively the similar benefits of investing in REIT and SM REIT. Only difference is in SM REIT, you get a little bit more clarity into the asset you're owning. And a little bit more visibility. You were able to see the title report, the leave and license agreement, and that psychological comfort that in this asset, I'm a 1% owner.
And do you see the runway for growth for platforms or investment options like REITs growing exponentially in India?
I think REITs specifically, and if I'm not talking about SM REITs, if you look at the smallest REIT, the market cap, if I'm not mistaken, is about 12,000 crore. Now, the issue is that there are not that many developers in India who have rental assets of 12,000 crore. They're the 4 ones that they're already there, and I can name maybe 2 or 3 in my head, maybe a DLF or a Prestige or a Punchshield. But other than that, there are not that many developers or asset owners who have such quantum of assets, which is where I think, again, this SM REIT framework comes in.
So, Shiv, for fractional real estate, I mean, for the most part, when you Google it, you get a lot of articles about how HNIs are really looking at this category in a big way. What is the profile of investors that are currently investing in fractional real estate?
So see, for the most part, our investors are, mid to senior level executives in large Indian corporates, MNCs. So professionals for the most part who are earning decent salary. You have then lawyers, doctors, chartered accountants. We had a few military personnel who also invested. So that, for the most part, is our category of investors. Ultra HNIs, for the most part, would make an investment themselves. So this is capturing that market. And about 25 to 30% of our investors are NRIs. Again, who would be of a similar profile. Predominantly, we've seen investors from the Middle East, NRIs from the Middle East, Southeast Asia. But then we've also had a few investors from Europe, US, and Africa as well. All NRIs.
Okay, so for these NRIs, given that it seems like a lot of them are looking at this as a lucrative opportunity to invest, are there any prerequisites or how does the regulatory framework work?
So there are no prerequisites per se. Obviously, this investment as of now is on a non-repatriable basis. Number one. Number two is the TDS that's deducted. So, and this is a little bit technical, but obviously, depending on the tax treaty that India has with the country that they're in, they can file a tax residency certificate to get a lower tax deduction rate. But otherwise, there's no real challenge from an NRI perspective to invest.
So we did talk about the importance of having, an unbiased financial advisor. But how much do you think one should allocate to putting their money down or investing in fractional real estate or this alternative form of investing?
Right. So, like I mentioned, 50% of Indians' investment has been in real estate. Now, obviously, that's inherently what Indians have been doing on average. How much one should invest? Obviously, like you mentioned, people should talk to their financial advisor depending on what their goals are. Whether they're early in their career, whether they're retirees. But I'd say, in my opinion, what we've seen so far is people investing anywhere from 15% to about 40 odd percent in our asset class of their net worth.
What are the top cities for fractional real estate? Does it still remain some of the metros?
So I'd say the top cities are basically, and if I'm talking in terms of assets, right? So if I'm talking in terms of assets, it's effectively the office markets of India.
Okay.
So exactly what you said, it would be the top 6 cities: Mumbai, Pune, Bangalore, Hyderabad, Chennai, and NCR. There are a few other cities that are up and coming, but I think these 6 cities would be the most prevalent office markets of India.
For the fractional ownership platforms, are there any specific licenses that they need to obtain or any specific registrations?
So now with the obviously new SEBI regulation, they'll all need to get a SM REIT license and be registered as a investment manager of an SM REIT. Earlier that wasn't the case, but now that is going to be the case.
And if we were to take a step back, you did give a lot of comparisons to mutual funds, right? How is fractional ownership different from REITs, mutual funds, or direct property investment that we spoke of?
Right. So direct property, obviously, I mentioned in terms of mutual funds or equity investments, your upside could be higher. So I will be, fractional ownership, you're going to get 15, maybe 17% IRR at best. You're not going to get higher than that. In equities, you can get 20%, 25%. But depending on what you invest in, you can also go down. In fact, we've seen what's happened in the public markets in the last 1 month. So I think that volatility is not as significant in the fractional ownership space compared to the mutual fund or equity market.
Shiv, if you had to list down top 3 reasons as to why investors should go into fractional real estate investing, what would they be?
I think there would be low risk.
Okay.
Number 2 is returns that are between debt and equity. And I'd say the final is that you're owning a hard asset.
Okay. What types of properties are best suited, according to you, for fractional ownership? It's only commercial, right, in India?
So, yeah, I think residential, the return profile, and so just coming back to it, with the SEBI regulation, you're only permitted to invest in constructed assets that are already rented out.
Okay.
So when I look at that universe, residential, your returns are only 2 to 3%. But if I say non-resi, to be honest, there are a lot of attractive asset classes. So far, we've only done offices.
Okay.
But offices are good, warehouses are good, schools, hospitals, data centers, a lot of these asset classes. Then it depends on the specific asset that you're investing within this asset classes. But in a growing economy like India, I think all of these sectors are poised for good growth.
And before investors decide to actually commit to fractional ownership investment, what do you think would be some of the important legal documents that they need to review?
From their perspective?
Yes.
From their perspective, I think it would be important to review the, what we have on our platform. We have the leave and license agreement with every tenant. We have the draft sale deed that is going to be signed. So these 2 documents ultimately is going to be where your returns are coming from. So I'd recommend the investors to review that. So other would be the title report, which would effectively be making sure that there's no title issue with your property, and would recommend one would get that when you're dealing with a platform. One should look at platforms that are dealing with tier 1 law firms.
Okay. Now, what happens if a property under the fractional ownership fails to perform, or there are some unforeseen expenses that need to be incurred.
Right. So see, on the fails to perform side, I think let's talk about the risks that could happen in a fractional ownership investment, right? You're investing in a property that's already constructed, that's already rented out. Tenant is already in place, and if your tenant is credible, right? So some of our tenants are ICICI Bank, Toyota, Microsoft. So you're getting rental on a monthly basis. Now, what could happen in that property? Your risk is a vacancy risk. So your risk is that if and when the tenant needs to relocate or move, then your property may lie vacant for a certain period of time, and that will impact your returns. So one is to look at the ability, when you're making that investment, what is the likelihood of that happening from a tenant perspective? So to give a few things to look at, one is to look at, what is the lock-in that the tenant has in place? What is the rationale for the tenant being there? Is it a head office? Is it a lab? What kind of capex the tenant has done on that premises? So, understanding a lot of these parameters will help you figure out the stickiness of the tenant. What is the security deposit? What is the notice period that the tenant has if they want to leave? So once all that analysis is done, you'll have some idea as to how long the tenant is going to be there. At the same time, obviously, things can change, and even after you do all your research, the tenant might leave. Then you have to look at the ability of the investment manager or the fractional ownership platform and their ability to release the space. So that's where the background of that investment manager comes in. Are they entrenched in the real estate space? Would they be able to release that property? The other thing I did mention is the rental value. If you got in at a lower than market rental value, then it will be easy to release that space if that tenant does leave. But yes, ultimately, even if you check all these things, there is a risk that for 3 months, 6 months, your property may lie vacant.
Okay.
And that is a risk of commercial real estate investment. Second risk is market risk. Depending on how your economy is doing, if your economy is doing well, your price of the asset will rise. If your economy is doing poorly, though, I think what we've seen traditionally in the real estate space, though, is that your price doesn't tend to fall in real estate. What happens is that it just stagnates. And transactions don't happen. So what one would recommend in that case is just hold tight, hold for a few more months to a year, and you'll be able to sell your asset.
Okay. Those are the main risks
Those would
of
be the
investing?
main risks. Absolutely.
Okay. And what if I have invested in a fractional real estate property and I want to pull out prematurely? Does that put the other investors at risk, or how does it work?
No, that doesn't put the other investors at risk. And in fact, we facilitated a lot of transactions for investors who wanted to exit their share in a year or so because of nothing to do with the asset, but they have some medical need of funds, or their child is going to studies and need it for educational purposes. So far, see, I would say it's not as liquid as the stock market where you are able to exit the same day. But within 30 odd days, we've been able to give all our investors an exit. And as the industry grows, as the awareness of this concept increases, as people get listed with the new SEBI regulation, that 30 days will come further and further down.
So how are properties evaluated or selected for fractional real estate opportunities?
Yeah, so this is obviously the most important question, and that's where we, differentiate ourselves to other players, and because that's ultimately going to define and determine the investor's returns. So we're very particular in this process. The first step is obviously the sourcing of the assets. And in terms of sourcing, we have to make sure that we have a big enough funnel that we're looking at all the assets that are there in the market. So for example, we would be evaluating about 2,000 to 3,000 crore of assets on a month. And that's because of our broker network, our relation with IPCs, your JLLs, Cushmans of the world, as well as with direct developers, we'll be sourcing a bunch of assets. Once we get these assets on our table, we evaluate it across multiple parameters. So one is the building quality, tenant quality, how good is the tenant? Where is that building in that neighborhood or the micro market? How good is that micro market faring from a city perspective? So we look at all these parameters in detail. We study the financials of the tenant. Given the real estate background that we have, the quality of the construction that's happened in that building. And then we look at the agreement between the tenant and the current landlord. What is a lock-in, notice period, etc. So in fact, we've had a situation where a lot of parameters matched, but the agreement wasn't strong. So we went back to the seller, said, get this agreement signed with the tenant, we're happy to step in. Finally, your rental and capital value. So when we look at the rental and capital value of that property, we ensure that we're picking it up at below the micro market average. And we do that through, you're able to access each and every leave and license agreement in each and every sale transaction is actually public info. So we make sure that we are at a below market average when we pick up that property. So that's on the commercial side. And then after that, obviously, comes the legal due diligence, where we work with tier 1 law firms like Sharda, Ramalch and Mangaldas to make sure that on the title side, everything is clear.
Okay.
Only after that do we go ahead and acquire the property.
Do you think, it's more suitable for fractional real estate investment for younger people like millennials?
I don't think it's a question of age. I think it's a question of what your investment philosophy is. I think fractional ownership, what it gives you is it obviously gives you that monthly rental income, which a lot of other investments don't. Sure, in equities, you do get the dividend, but the dividends are generally about a couple of, 2 or 1 or 2%. Here, you're getting 8 to 9% monthly income once you make that investment, which a lot of our investors look forward to.
And how is technology transforming real estate opportunities in the country?
So we are actually doing a lot with, and we have a tech team in place. In fact, our CTO is IIT Bombay, etc. So we're doing a lot on the AI front right now on both sides, right? So one on the investor side, we're streamlining the whole investment process to make it, phygital. Obviously, you'd always require RMs, relationship managers, but we also have kind of chatbots in place, easy KYC process in place to streamline your investment journey. But the very unique thing we're working on is on the real estate side. So like I mentioned, we analyze all this data of the micro market, etc. Right now, it happens at a human level. But what we're working on is pulling out all the data and having a map of each and every transaction that has happened historically and that is continuing to happen, which will very quickly, we're developing algorithms and AI that very quickly tells you the right price for an asset in a certain location. So that's a project that our team is working on right now. And I think that has the ability to revolutionize the way real estate investments happen in the country.
Are there any misconceptions that people have regarding fractional real estate investing that you want to, bust? Any myths you want to bust?
So I think obviously because it's a new concept, people are a little bit unfamiliar with the market. And obviously real estate, unfortunately, and maybe rightly so because of a certain, section of bad investments that people have made in the past. Real estate people have been a little bit hesitant towards. But I think here the difference is that you're investing in assets that are already constructed, already rented out, and it's not an under construction investment.
Do you think that fractional real estate can disrupt the real estate market the same way that we saw fintech completely disrupt the banking sector?
Absolutely.
Yes.
Yeah, 100%. And I think it's because of what I mentioned earlier, right? The capital that it brings to a market or an industry that's generally capital starved on one hand, and it allows, developers now, when they start constructing a building, their only exit option is not Blackstone, Brookfield or a REIT, which was only limited to the top 5 developers in the country. So now developers, when they construct, they know what they can exit into. And because of that, they're able to build a much better project and know that they have an exit option, take their money out and build a new project. So I think this will really catalyze the overall real estate market.
So what's the future of fractional real estate investment in India?
I mean, I've been saying this for a few months now, but once the SEBI regulation came, this is the mutual fund moment for the real estate industry. Right? Mutual funds today are 50 lakh crore. I don't see why fractional ownership can't get to that level in about a decade or so.
So Shiv, who should not be looking at fractional real estate investment as an option?
Yeah, so I think anyone who wants to kind of, invest and get out in a few months thinking there'll be returns, this is a longer term investment, especially.
But I guess that just goes against investing as the definition, right? If
Absolutely.
You want in and out.
Exactly. I mean, there are certain people who are day traders, for instance. So that's a very different psychology. Here, it's you invest and your appreciation will come after, a few years. 4 5 years is when the real appreciation kicks in. So people do have to have a little bit of longer term view when they're investing in fractional ownership.
And so what should the mindset of a fractional real estate investor be?
I think the mindset should be that I'm putting this money down. I'm going to keep getting my monthly returns. And then in 4 to 6 years, I'll see a nice appreciated return in that sense.
I know you've busted myths and everything, but I can just still imagine if I were to go to my dad or something and say, hey, fractional real estate, I heard about this platform.
Yeah.
It'll need more than just these are the 3 pros and these are the cons. What do you want to tell maybe the older generation who's so used to the traditional forms of investing, be it in real estate assets or in mutual funds? What do you want to tell them?
I think what I would like to say is that, and especially now with SEBI coming in, I don't know about your father, but he might be investing in, say, a Tata stock or a Reliance stock jointly. It's the same thing for real estate.
Okay.
Yeah.
So
So if you're already investing in the stocks, which is a share in a company, this is a share in a property.
Why not?
Yes.
So when it comes to listing, given that it's a fairly new concept, the regulations have just come into place, what is the process? What is the future that you foresee in India?
Yeah. So with the new regulation, right, there's a window that SEBI has given for all the past assets that we've done for them to migrate to the listed entity, which we're working on. And we'll be communicating to our investors the timeline, etc., for that, which then allows, people who've already invested in the older structure to ideally migrate to the newer structure. Second is for new assets that we list. So anytime we list a new asset, it's effectively going to be an IPO process. So every time we list, 50 crore, 100 crore, 200 crore asset, it's going to be as if it's a fresh IPO. So the same way you're investing in an IPO of a Swiggy, it'll be a similar process to invest in this. So ideally, there'll be at some point, you'll be able to invest through your broker, whether it's a Motilal Oswal, whether you're a local broker or through a Zerodha. And it's going to be as if you're investing in an IPO, the exact same process.
I know we've spoken a lot about, how investors should pick and choose and decide whether this is for them. But you have crowdfunding, you have REITs, you have fractional ownership. So how does an investor decide what option aligns best with their risk appetite and with their financial goals? What is the messaging that you want to send?
So I think the messaging is that in this asset class, you have complete transparency. You get detailed reports into the title, leave and license that you wouldn't in other investment avenues. At the same time, your headache is removed because we manage everything.
Thank you so much, Shiv, for joining us and giving us so much more clarity on fractional real estate investment. I guess some of the key takeaways would be that you own a hard asset, it's a fairly low risk, and compared to equities, you're making a decent return. So I guess people will wait to have a slice of that pizza now.
Thanks. Great being here. Thank you.
Thanks so much for watching this episode. We hope you understood a lot more about the world of fractional real estate investment. But do remember, it's very important to consult your personal financial advisor who is certified with unbiased opinion. Would you invest in fractional real estate? We'd love to know in the comments section. So do share your comments, like, share, and subscribe.